Well, hello again, class, and welcome to video number whatever, 5, 6. This is going to be a little short tutorial on the balance sheet. We've been talking about the profit and loss statement, and that's a important management tool that informs you about whether your strategy is effective and whether your management team is catching everything that they should, whether they're seeing everything in the external environment, whether the relative strength of buyers and suppliers and new entrants has changed. And so the profit and loss is a management tool. It's a historical tool. In other words, when you look at a profit and loss statement, it doesn't tell you about what's going to happen, it tells you what happened. And so you look at what happened and you make a determination whether I have to make some changes to what we're doing from a management perspective. The balance sheet is really a much more interesting document because a balance sheet it essentially records or has buried in its body every single thing that has happened since the company was started. So what I think of it as is many of you, I don't know if you're maybe too young, but when I was young, we used to get a bank book when we were at school, and every week we would go and we would deposit $1 or 25 cents or whatever it was. We'd go down to the cafeteria. And many years later, you would find that bank book in a drawer, and you'd look at that bank book and you'd look at it and you'd say, oh, look at this, I had $75 at a certain point, and then I had $3. What happened? Oh, I remember, I bought my bike. So that's what happened to that 70 some dollars, that's $72. So everything, all of the DNA, the financial DNA of my little life when I was in elementary school, it was all in that bank book. Well, the same can be said about a company's balance sheet. It literally is a running total. It changes every single day. And there's a reason for that, and I'll go over that. But for starters, let's just talk about what the balance sheet is. The balance sheet consists of 3 sections. It consists of assets, liabilities, and shareholder equity. And in fact, there's an equation called the balance sheet equation, and I just happen to have it right here. See, this is the balance sheet equation. Assets equal liabilities plus shareholder equity. Now, sometimes in the Wall Street Journal or the New York Times, there will be a bond offering or a stock offering from a public company. And when they do that, they list their assets and their liabilities. And when you see, that document in the newspaper, you'll look down and you'll say, oh, the assets, they have $50 million of assets. I wonder what their liabilities are. Well, wait a minute, they have $50 million of liabilities. How did that get arranged? How was it possible to make the assets equal the liabilities? And then you look at another one, and sure enough, the assets are equal to the liabilities. And over and over and over again, the assets are equal to the liabilities. How do all these companies manage to have exactly the same number of assets that they have liabilities? Well, the magic number is shareholder equity. Right here, shareholder equity. That's the plug number, because shareholder equity will rise and fall as the balance between assets and liabilities changes. And so it becomes the number that is plugged into the equation that makes liabilities equal assets. Because as you can see, shareholder equity is on the same side of the equation as liabilities. That's because shareholder equity is a liability to any company. And you say, what? Shareholder equity? Equity is a good thing, right? Liabilities are bad things. How can shareholder equity be a liability? Well, shareholder equity, just like every liability, is a claim against the company. And what do I mean by that? Well, I mean that if the company was to go bankrupt and liquidate all their assets, all their furniture, all their gear, and if they ended up with $10, the shareholders would be entitled to a percentage of that $10. It might be 50 cents, whatever. But that is the shareholder's claim against the company. And you say, well, wait a minute, that's my company. So, I don't want to take any money. No, if you're a shareholder, then yes, in the event of a bankruptcy, you're going to get your percentage of the leftover monies. Okay, so I'll show you how this works. Okay, so let's say we have $1,000 in assets equals $500 in liabilities, right? Well, no, not right, because we got this little thing here. What does that mean? That means $1,000 equals $500, and we all know that that is not true, correct? So how do we make that equation work? Well, we add shareholder equity. And all of a sudden, 1,000 equals 500 plus 500, and it makes perfect sense, because if you only have $500 in liabilities and you have $1,000 in assets, well, then you've got $500 of equity. You've got an additional $500 that is yours. That's excess, that's profit. Okay? Now it works both ways though. So suppose you have $1,000 equals $2,000, right? We're right back to where we started, because we've got this little equal sign, and assets always equal liabilities. So you've got $1,000 in assets, you've got $2,000 in liabilities. So your liabilities exceed your assets by $1,000. So how do we fix that? We go like this. Okay, we add minus $1,000. Okay? And so that tells you that the company has negative equity. It has no equity at this point. You need to build that equity up. So now we all have, in a sense, we all have personal balance sheets, don't we? Because you have a college education that you're currently paying for. Okay? So you could reasonably say that that college education, you're building up a liability, correct? And so you could have, well, let's stay with our $1,000. You could have $1,000 in the bank, and that could equal, let's say your college debt is $100,000. Okay? Well, $1,000 does not equal 100K. So we have to add minus $99,000. Okay? Okay, so that's the day you graduate. But over the years, let's say maybe over 10 years, your assets are going to grow because you're going to make money, you're going to save money, you're going to acquire a home, you're going to acquire a car, you're going to acquire other things of value. And so after a decade, let's say, well, you know what, let's be more positive. Let's say after 3 years, okay, it's going to look a little bit different. It's going to look like this. You're going to have 150 equals 75K, right? Okay, 150 because you got a good job and you saved $50,000 a year. Okay, maybe you acquired a home and that's part of that asset number. And in the meantime, you paid down over those 3 years, you paid down, you know, a little over $8,000 a year. So instead of having a $100,000 college loan, you now have $75,000. Okay, so $150,000 of assets against $75,000 of liabilities. Well, the only way to make that even is you have shareholder equity of 75K. Okay, so some good things happened, right? You went from starving college student with a degree and no job and a lot of debt to a thriving, money-making musician who now has $75,000 of personal equity, of wealth. Okay, that's how the balance sheet works. Now there are other aspects to the balance sheet that I can't, you know, do on a whiteboard, a little whiteboard like this. But let me get into it. Let me get into as much of it as I can, actually. I probably should have two whiteboards. You know, a whiteboard in waiting, a whiteboard that I filled out so we don't have to wait while I do this. But, you know, by the time we get to the end of this class, I'll have this whole thing nailed perfectly. So, okay. I'm going to do it lengthwise. Okay, balance sheet. I'll just say BS. Okay, assets. Liabilities. Okay, and then shareholder equity. I'll just call that SE. Okay, now you all see that. Okay, assets are listed on the balance sheet in order of liquidity. Okay, so by that I mean, what could I liquidate today? What could I liquidate in 30 days? And what could I liquidate in 3 years? Okay, so you have short-term and long-term assets. Well, you know, the best asset that you can have that you can liquidate right away is cash. Okay? Below that, and in a business, this is vital, receivables. Receivables are created when your accounting department generates an invoice and sends it to a client. That's a receivable. If they do a receivable for $1,000, in other words, they're billing a client for $1,000, that is automatically a $1,000 asset. And it's a current asset, it's a short-term asset because receivables come in within 30 days, okay? Long-term assets are things like gear, wait a minute. Let me see if I can write this here. Buildings. Okay. And the reason that these are long-term liabilities is because they're going to be paid off over time. You can't liquidate them quickly. And especially in the case of real estate, it might take several years, particularly if you have a large building to unload. Liabilities are the same way. You start with current liabilities. Now, your most current liability is going to be the money that you owe for work that was done on the various projects that you do. Okay? So that's called accounts payable. Okay? Accounts payable. So every time you use a service, you get a bill. You go and you rent a dub stage. They send you a bill. You hire somebody, a contract worker. Now remember, your payroll employees, they don't show up on your balance sheet. They're on your P&L. But when you are going out and being invoiced for various things, that's in your accounts payable. That's money that you owe. Okay? Remember I said the balance sheet changes on a daily basis? Okay, receivables. We billed $10,000 in receivables today. Oh, guess what? We got $5,000 in bills that we owe. All of a sudden, the balance sheet equation shifts, right? We paid $50,000 of accounts payable this week. Oh, all of a sudden, our liabilities drop. Okay? And our assets are greater than our liabilities at that point, let's say. Okay? And all of it changes on a daily basis, as does your shareholder equity number. Okay? So that's how the balance sheet works. I'm going to send you something in more detail. We're going to talk about this in Thursday's class. But these are the basics. I wish my artwork was a little bit better, but once we discuss it face to face and you ask some questions, I think you're going to understand the balance sheet a lot better. Okay? So think of this as just an introduction, that's designed to completely confuse you. Okay? Okay. I will talk to you later. Bye-bye.